Hello, dear collection. Very good morning to all of you. Welcome once again for this presentation for these lectures. Uh, First of all, I, Dr. Jamal Abdul Nasir Ansari, Assistant Professor in the Department of Commerce, Integral University, Lucknow. Today we will discuss the concept of accounting for the amalgamation, and we will study the concept of amalgamation from the numerical perspective as well as from the theoretical perspective. We will study the concept of amalgamation first theoretically, means what are the background of the amalgamation, why the concept have been emerged in India, and similarly we will study the concept of amalgamation from the perspective of the accountancy, means what will be the accounting treatment for the amalgamation of the company. And before go for accounting treatment of the amalgamation of the company, we will study the concept of amalgamation from the business perspective as well as for the uh, as well as what are the common definition of amalgamation and why these concepts amalgamation, merger, acquisition, external reconstruction, internal reconstruction, why these all concepts came into existence, means what are the differences between these two concepts, between among the concepts like amalgamation, merger, acquisition, and all these things. So in this presentation, in this video, we will study, we will learn, we will get in-depth knowledge of amalgamation, how it works, means what will be the accounting treatment for these, as well as what are the meaning of amalgamation. With the help of suitable case studies, we will going to study the concept of amalgamation of the company. So now come here and be concentrated. We are going to study, we are going to start the concept of amalgamation of the company. So first try to understand the concept of the amalgamation of the company, means what are the meaning of the amalgamation and how it differs with the acquisition, with the uh, purchase, with the merger, with the internal reconstruction as well as external reconstruction, and how the amalgamation of the company work in India, as well as from where this concept amalgamation came into existence. So first, now try to understand the concept of the amalgamation from the business perspective, means its meaning. So amalgamation basically refers to the combination of two or more companies into a single entity. When number of companies are there, right? Take the examples of cement industry, for example, JK Cement as well as Ambuja Cement, or you can take the examples of Ultratech Cement too. So when these two or more than two companies come close, means the operation of the existing company is going to close, and one new company came into existence. It is known as the amalgamation. But it is to close with the merger of the companies too. In case of a merger, the company must be same in nature. For example, if you remember well, the merger of Idea as well as Vodafone, these two companies, these two major players are from the same domains, means from the telecommunicating companies, Vodafone as well as Idea too. And one new company came into existence which is known as the VI. Presently it is working, this company. So this is the case of the this is the case of the merger, not the amalgamation. In case of amalgamation, it is not mandatory that the company must be same in nature, means the operation of the company, it does not mean it must be same. It may be different, right? Maybe Ultra Cement Limited, Ultra Cement with the Reliance Jio. So this company is going to amalgamate, and one fresh company came into existence, means all the assets as well as liabilities of the existing company going to close down. Right? Mean all the assets as well as liabilities going to record, right, in new books of accounts, which is known as the consolidated balance sheet. So this is the case of the amalgamation. So its meaning are, it refers to the combination of two or more company into a single entity. It is a combination of two or more companies into a entirely new entity, entirely a new company came into existence after the close this after the closing down of closing down the operational activities of two or more than two companies. Amalgamation are distinct from the acquisition in that none of the companies involved in the combination survive as a legal entity. So, amalgamation means the existing companies that merge, or amalgamated means transferor company as well as the transferor company. Transferee and transferor. There will be two company. Means the going to amalgamate is known. It will be known as the transferee company, and who is going to from whom is going to it will be known as the transferor company. So the new existing company, the over the business of amalgamation companies, it will be known as the amalgamated means transferee company. So amalgamation basically is a process of closing, merging two or more company and a fresh company came into existence. It is known as the amalgamation of the company. You can say in very simple words, it refers to the combination of two or more company into a single company. It is known as the amalgamation of the company. So we will also discuss, the concept, the same concept means amalgamation of the company from the perspective of the accountancy means what will be the accounting treatment for the purpose of when a company go for liquidation, a company go for merger, a company go for acquisition, a company go for go for external reconstruction. In our previous discussion, we had discussed the concept of the liquidation, merger, as well as we had also discussed the concept of external reconstruction, internal reconstruction. So in this presentation, in this video, we will be studying the concept of amalgamation, right? Theoretically as well as practically too. So moving in this direction, and how amalgamation work? Right. So the question is rise that what are the definition of the amalgamation and how it is worked. So amalgamation typically happen when two or more than two companies engage in the same line of business or that share some similarity in their operations. Right. But it does not mean that the company should be in the same domain. Yeah, it may be in different the same business line. So how the process of amalgamation is going to take place means how the concept, how the amalgamation in India work. So when two or more than two company come close, right, engage in the same business lines that share some similarity in their operation. So usually the process involves a very large entity called the transferee company absorbing one or more sellers means transfer company before creating new entity. So one of the transferee company and will be the transferee company. So when these two companies combined are going to merge with each other and one new separate entity press company came into existence, so it will be known as the amalgamation of the company. So the term of an amalgamation are finalized by the board of directors of each company involved. The plan is prepared and submitted to the regulator for the approval. So when we talking about the concept, we will be discussing the concept of amalgamation from the perspective of these law point of view. So necessary legal process, necessary legal formalities is going to take place when we're talking about amalgamation of the company, when we talk about the internal reconstruction of the company, or when we talk about the external reconstruction of the company, or when we talk about the amalgamation of the company. After passing a resolution, the company is going to submit a report to the board of directorate, and that report must be sent to the Ministry of Corporate Affairs as well as registrar of the company to get its approval for the amalgamation of the two or more than two companies. Without approval, without approval of the same resolution, a company is not supposed to make. A company is not supposed to do the amalgamation. Right? It is a beyond of the ultra wire of the Companies Act 1956, 2013, 14, 15, or whatever amendments are there. So how does amalgamation process work in India? It is a matter of the discussion. So in India, basically the process of amalgamations, right, means the authorities resides in High Court and Security Exchange Board of India. SEBI is responsible for all kinds of phenomena, for example amalgamation, merger, acquisition, or something else. So in India, right, Indian tax laws define amalgamation somewhat broadly. For example, the merger of one or more than one companies with another companies, or the merger of two or more companies form one new company. As per the Indian Companies Act, the word has been defined, which is here merger of one or more than companies with another companies, or merger of two or more companies to form one new fresh entity, fresh corporate, fresh company would going to take over the business of, not going to take over the business of, but all the assets as well as the all the liabilities of the concerned company, right, going to merge, right, all the assets as well as the liabilities going to reevaluate once again, and one new fresh balance sheet will be prepared, which is known as the consolidated balance sheet. So it refers to the merging, since amalgamation refers to the merging of companies, as amalgamating company or companies, while the company they merge with, or which is newly formed as a result of the merger, is the amalgamated company. So in India, SEBI is responsible for all kinds of merger and similar phenomena, for example acquisition, amalgamation, construction, and so on and so forth. So in 2022, one of the very famous case, just like telecom giant AT&T, the television entertainment company Discovery announced that they had finalized a deal to combine AT&T as Warner Media business unit with the Discovery. So this is what the examples of amalgamation. So it was a very famous case in the month of the April to 2022. So there are two companies which are from the same business lines, means there are two companies which from the entertainment industry, like one of the company named here as AT&T, and the second one is a television entity company Discovery, right? So they merge and they combined, and a fresh company came into existence. So that once a new entity known as the Warner Brothers Discovery Inclusive began trading on the Nasdaq Stock Exchange under the symbol WBD, Warner Media and Discovery, ceased to exist. So when two companies, company X and company Y, merged, combined, one new company came into existence, a fresh company came into existence, it is known as amalgamation. So in a nutshell, in a very simple way, we can say that it is the process of it is a process of merging, or when one or more than one companies, mean two or more than two companies came into close, like come into closing down of its business, or going to combine its business, and one new fresh company came into existence. The rest two, means the past companies which combined, for example X and Y, is no more into existence in the eyes of law. Now fresh company came into existence. So in these examples, WBD, Warner Media Discover, right, it's one of the company which came into existence after the amalgamation of two company AT&T and television entertainment company, right? So Discovery, these two company came into close, means they combined with each other, and new fresh company came into existence, which is known as WBD in this case, right? And they start trading, means their shares going to be trading in the different stock exchange. So if we can say amalgamation in a very simple word, in a very simple way, that a company going to when two or more than two companies combined and new fresh company came into existence is known as the amalgamation of the company. So moving ahead in this direction, as just right now I told you, we will also discuss the concept of amalgamation of the company from the perspective of theories as well as accounting too. So how these amalgamation is differ with the acquisitions, how this amalgamation is differ with the amalgamation differ with the purchase consideration or the external reconstruction, as well as how this amalgamation different with the merger is a matter of the discussion. So as we have explained, right, in a typical amalgamation, two or more companies agree to combine their assets and liabilities and form an entirely new company. As just right now we have discussed that when two or more company means their business operation. What does business operations means? Closing down of their business operations and one new company came into existence, right? So it is a concept of the amalgamations. So the last two companies, transferor and transferee company, going to lose their legal entity, means no more in the there would be these two companies, transferor and transferee companies, no more into existence because they have lost their existence. Why? Because all assets and the liabilities of all this company, right, has been merged, has been combined with the fresh company, and now this company came into existence, which is known as the amalgamation, the concept of amalgamation. So in case of acquisition, in an acquisition, a company, one company purchase another company, is usually buying up enough of its stock and takes on its assets and liabilities with no company being created. So in case of acquisition, for example, X company have acquired the business of Y company. So there will be no any new BB came into existence. No new company will be formed. The remain company X will be remain into existence while the Y company will lost their existence. You know why? Because X company have purchased the stock of Y company. So it is the acquisitions. X company have acquired all the assets as well as liabilities, acquired the business of the Y company. While in case of an amalgamation, two or more than two company came in close, like combined, and a fresh company came into existence. So it will be known as the amalgamation. While in case of a acquisition is totally different with the amalgamation. In case of a acquisition, no new company came into existence. Only and only one company going to acquire the assets as well as liabilities of the other company. So it will be known as the acquisition of the business, not the amalgamation of the companies. While amalgamation tend to involve voluntary agreement between the different parties, acquisition can occur without the assent of the acquired company. This is known as the hostile takeover. So in case of a amalgamation, it is a voluntary agreement of all the stakeholder, right? A consent is required of all the stakeholder. But in case of a acquisition of the company, no consent, no assets are required of the acquired company. So it will be known as the hostile takeover. So moving ahead in this direction, right, so here are different types of amalgamation. So first, amalgamation in the nature of the merger. We will discuss the concept of amalgamation, which is in the nature of the merger, and similarly amalgamation in the nature of the purchase. So purchase consideration we have to find out. So what is this purchase consideration? We will going to discuss in the upcoming next slide. So first try to understand what are the classifications of amalgamation, right? So as broadly as per the Indian accounting standard, right, 14 as well as revised updated IND Indian accounting standard 103, a details guidelines, a detailed, you know, blueprint has been given there in the revised guidelines of Indian Accounting Standard 103, right? Over there, the concept of amalgamations of different natures, amalgamation of companies, what will be its accounting treatments, as well as what are the case studies of amalgamation of the companies, and what are the legal definition of the company, what are the operational definition of the amalgamation. Everything has been given in details manner in the Indian Accounting Standard 103. So we will going to study the concept of amalgamation in the nature of the merger first. So all the assets and the liabilities of the transferor company become those of the transferee company. So whatever all the assets and the liabilities of the transferor company become the of the transferee company. For example, X and Y. There are two private limited or limited companies, company X and company Y, and one new company into existence. So X and Y going to combine means the going to combine with each other. So the assets of X company as well as the liabilities of X company will be automatically become the assets and the liabilities of the Y company. So X company will be known as the transferor, Y company will be known as the transferee company, right? So 90 or more than 90% shareholder of the transfer company become the shareholder of the transferee company if the amalgamation will be the in nature of the merger, right? Means two or more than two company going to merge with each other, means the operational activities of the company is going to close down. All the assets and the liabilities of the transfer company by default will be the become of the assets and the liabilities of the transferee company, and more than 90 or 90% of the shareholder of the transferor company, which is in the example X company, become the shareholder of the transferee company automatically by default of hence in this example, which is the X company, it is known as the transferee company. So business of the transfer company will be continue, right? So I mean it does not mean if amalgamation if it will be in nature of the merger, so the business is still will be continue, means they are not going to shut down of the business, not going to close down of the business. So purchase consideration is discharged fully by issue of the equity. So when we talk about all the realization of all the assets as well as disposing of all the liabilities, so purchase consideration will be discharged, will be going to finalized by the issue of the equity share in case of a amalgamation in the nature of the merger, while no adjustment to the books value. So it is all about amalgamation in the nature of the merger. While moving ahead in this the same way on the same topic amalgamation, so the other classification of amalgamation is the amalgamation in the nature of the purchase. The transferee company does not necessarily take over all the assets and liabilities. If a amalgamation will be the in nature of the purchase, so here it does not necessarily that the assets and the liabilities of the transferee company take over of the all the assets and the liabilities of the transferor company. So the transferring company does not necessarily take over all the assets and the liabilities. Maybe going to not take over all any assets, like which is having some kinds of major legal considerations, right? So that sometime the transferring company will not going to become by default the assets and the liabilities of the transfer company if it is the case of the purchase. So consideration may be paid partly in cash or share. So you can just right now we had discussed that if it is amalgamation will be in the nature of the merger, so the purchase consideration is fully discharged by the issue of the fresh share. It cannot be discharged, it cannot be paid in cash. But in case of a purchase, the consideration may be paid only no cash as well as shares, fully or partly. Purchase difference is the treated as the goodwill or capital reserve. If any differences will be there in purchase consideration, so it will be either goodwill or it will be the reserve. So broadly speaking, there are only and only two classifications of the amalgamation of the company. First one is known as the amalgamation in the nature of the merger, and second one is known as the amalgamation in the nature of the purchase. So I hope that the concept of amalgamation of the companies is yet to clear to you, right? And after a lot of discussion of amalgamation and its meaning and its classification, just have a quick recap of what we had discussed just right now. So amalgamation basically is a process of is a combination of two or more company, and one new fresh entity came into existence is known as the amalgamation of the company. While it's have a while a merger and purchase acquisition is totally different with the amalgamation. So when we talk about its various classification, it's have two classification: amalgamation in the nature of the merger, amalgamation in the nature of the in the nature of the purchase. So both have different characteristics which is totally different with each others. Moving ahead in this direction, as we had discussed in the earlier, that we will study the concept of amalgamation, we will study the concept of liquidation of the company, acquisition, and more on, and so on and so forth, from different perspective. So what will be the accounting treatment for the purpose of amalgamations when amalgamation in the nature of the merger? So what will be the accounting treatment, how the assets and liabilities are going to record it, right? And what are the books of account, how the books of accounts are prepared, as well as what about various reserve of both two companies, as well as what about the profit of various companies assets and liabilities. So all these things is going to be calculated once again if it is the case of the amalgamation in the nature of the merger. Similarly, if amalgamation it is in the nature of the purchase assets as well as liabilities, how it's going to record, right? So first point, first matter of the discussion is what, in case of a amalgamation which is in the nature of the merger, so assets, liabilities and reserve are recorded at the existing carrying amount, not the book value, not the fair value. Means at per the balance sheet of the companies of the transfer transferee company, right? Transfer companies, right? At the value, means at the existing value. For instance, suppose the balance sheet of X Limited having the liabilities, and one of the liabilities named as the creditors amounted to rupees 40 lakh. So it is going to record at the existing amount, at the existing rate is 40 lakh, not book value, or not a single asset is going to record at historical cost basis, but as per the existing value that particular assets carrying. Similarly, all kinds of reserve of the transferor company continue in the transferee companies. If there will be any kinds of reserve, for example, general reserve, for example, capital reserve, or anything else reserve are there, it will be going to continue in the books of. So, just right now we have discussed, right, the concept of amalgamation, right, accounting for the amalgamation of the company if it is the case of the merger. So all the liabilities and all the assets, all the reserves are recorded at the existing carrying amount. While the reserve, if there will be any kinds of reserve, for example, capital reserve, general reserve, or any types of reserve, so it will be going to continue in the books of transferee company. And if the amalgamation will be in the nature of the purchase, and what will be in the nature of the purchase, we had discussed, we had told that the all the operation of the transferor company will be continued. So just right now, just right now we have discussed the concept of amalgamation from the numerical point of view, right? And means what will be the accountancy for amalgamation if it is the nature of the merger as well as if it is the nature of the purchase. So in case of a purchase, if the amalgamation is in the nature of the purchase, so purchase methods means assets and the liabilities are recorded at the fair value. All the assets as well as the liability will be recorded at the fair value. Similarly, if while calculating the purchase considerations, means the difference between purchase consideration and the net assets, it will be goodwill or it will be the capital reserve. So when it will be called goodwill and when it will be called capital reserve if consideration exceeds more than the net assets. So what is net assets? What is consideration? We will going to discuss all these keywords, all these phenomena in the upcoming lectures. So if consideration is will be more than the net assets, it will be the goodwill, and if consideration it will be the less than the net asset, it will be known as the capital reserve. So moving in the same concept in the same domains, we are going to discuss other phenomena. Means what is the purchase consideration? Just right now I have told you, we had discussed that what is purchase consideration, what is goodwill, what is capital reserve, and many more things we have discussed. And since half an hour, around half an hour, we are discussing the concept of amalgamation and many more important phenomena. So now try to understand what is purchase consideration, means how it has been defined. So amount paid by the transferee company to the shareholder of the transferor company is known as the purchase consideration. Go back to our previous discussion. I just told you that X and Y companies and one new company came into existence. So the company X will be known as the transferor company, company Y will be known as the transferee company, and one new company came into existence. So discussing about the purchase consideration, so we can say in very simple language the transferor company and the transferor company. So whatever the amount will be paid by the transferee company to the transferor company shareholder, it will be known as the purchase consideration, and it will be excludes the payment to the debentures holder, creditors, and many more liabilities. So it is not going to include all these dimensional liabilities, for example debentures holder or creditors or something other liabilities, it is going to exclude only some liabilities which have been mentioned in the in these amalgamation perspective will be going to record from the point of view of the amalgamation. So but it also includes cash, shares, equity or preference as well as other assets. So it the number the said liabilities will be going to exclude while calculating the purchase consideration. Meanwhile, it is going to also include some mentioned assets, for example, shares, cash, or any others. At the time of the calculating of the purchase considerations, the point will be kept in mind that the said assets, the said liabilities will be excluded as well as the said assets will be included. So moving ahead in this direction of the purchase consideration. So how the concept, so we had discussed the concept of the amalgamation of the company, right? Amalgamation, types of amalgamation, means purchase consideration. What is purchase consideration? And just right now we have told amount paid by the transferee company to the shareholder of the transfer company is known as the purchase consideration. So what are the various methods to calculate the purchase consideration? First method is the what? Lump sum method, right? Means a fixed total amount is paid, given directly to the shareholder of the transferor company by the transferee company. it will be the known as the purchase consideration, and this method will be known as the lump sum method. Similarly, second and most important method is the net assets methods. It means assets taken over minus liabilities taken over. So the how this purchase consideration will be decided, we can say this PC, purchase consideration. So purchase consideration will be agreed value of the assets minus agreed value of the liabilities. It will be known as the purchase consideration. As in our previous slides, I have told you that how what are the meaning of the net assets. So the meaning of net assets has clear here, means net assets means assets taken over minus liabilities taken over. So the final difference will be known as the net assets method. So purchase consideration will be decided here agreed value of the assets minus agreed value of the liabilities. It is the second most important method for the purpose of the purchase consideration calculation. Moving ahead, the third method will be the third method is net payment method, means total of cash, shares, debentures issued to the shareholder. So per how the purchase consideration is going to calculate. So PC is equal to, means purchase consideration is equal to total payment made to the shareholder. The third method is for the purpose of the calculating of the purchase consideration. So similarly, the intrinsic value method, the last method is the what? Intrinsic value, which is the fourth method, based on the intrinsic value of shares of both companies, means transfer company and transferee company. So at both based on the intrinsic value of transferor as well as transferee company. So purchase consideration will be decided. So in terms of formula of purchase consideration is equal to intrinsic value of the transferor share into exchange ratio. So these four are the method of the purchase consideration, means how the purchase consideration are going to be calculated. Moving ahead in this direction, just right now we had discussed, we had told you in our earlier class, in our previous, at the beginning of this video, at the beginning of this presentation, that purchase considerations, what is the amalgamation of the company, and we're also going to study the concept of these amalgamation of the company from business perspective as well as from the uh, uh, accountancy perspective. So now with the help of the numerical information, with the help of illustration, we will going to study the concept of the purchase consideration, means how a purchase consideration is to going to calculate. So for example, X Limited takes over the assets as well as the liabilities of the Y Limited as on 1st April 2025. So details of Y Limited. So Y Limited will be known as the transfer company, and X Limited will be known as the transferee company. As in the said example in our previous slide, just right now we had discussed that X Limited and Y Limited came into existence, came closed, and operation of both the companies going to close. One new company came into existence, which is known as the XY, or whatever the company named may be. So for the purpose of the purchase consideration, so here the assets as well as the liabilities of the Y company have been mentioned. Assets amounted to rupees 8 lakh, as well as the liabilities of the Y company was mentioned 3 lakh. So the purchase consideration agreed at 6 lakh. So what will be the general increase, means the first cycle of the account, for the first first stage of accounting cycle is the general increase. So general increase will be passed in both two companies, transfer companies as well as the transferee company. So in case of the transfer company, right, so whatever the realized value of the various liabilities as well as various assets going to record. So the entry in case of a transferor company will be like that, right? The first aspect means the transferor company. So realization account will be the debited, which is amounted to rupees 8 lakh. All the liabilities as well as all the assets will be going to creditors. Means two liabilities account 3 lakh and two assets amounted to rupees 8 lakh. Right, and the purchase consideration had been decided, which was amounted to rupees 6 lakh. So by way of all these things, there will be the profit means to realization account 1 lakh. So similarly, uh, general entry will be also passed in the books of transferee company. So assets which was amounted to rupees 8 lakh and the liabilities will be amounted to rupees 3 lakh and goodwill will be amounted to rupees 1 lakh. To the purchase consideration, as just right now discussed, it will be amounted to rupees 6 lakh. So in this case 1 lakh rupees will be known as the goodwill, right? If you remember well, in our previous slide, as I told you, and I will also discuss the capital reserve as well as goodwill, how goodwill will going to there. Like if assets more than the purchase consideration, so it will be known as the goodwill. Similarly, what will be the accounting for the instructional legal? So after these amalgamation of the companies, amalgamation having the two types, right? Amalgamation in the nature of the merger, amalgamation in the nature of the acquisitions, right? We had also discussed that how the purchase consideration is going to be calculated, right? Means if assets will be there and capital reserve will be there or account goodwill will be there. Its books of account means from numerical perspective, from the accountancy perspective. We had also discussed the concept of amalgamation, from accountancy point of view, means how books of accounts are prepared, journal entries and so on and so forth. So under discussion on the same phenomena, which is what reconstruction means, accounting for the reconstructions, right? So now first try to understand what does it means, right? Instruction reconstructions is the process of recognizing a company's capital structure without liquidation, no acquisition, no amalgamation, no merger, nothing, right? Means internally going to overhauling of the companies, a going to make a self-assessment, assessment of various assets as well as various liabilities of the company without the process of the liquidation, without the process of merger, without the process of the amalgamation and so on and so forth. It is done to eliminate losses or write down the overvalued assets, and the most important objective of these internal reconstruction is to write off the accumulated losses, to revalue assets and the liabilities. Means if assets are valued under or over, or any liabilities have been valued or less or more or less, it is going to revalue of all the assets as well as the liabilities to make the balance sheet realistic, right? Means all the assets and the liabilities are once again going to revise, right? And the fresh balance sheet will be prepared and to enable payment of the dividend. So these are the various objectives of the internal reconstruction of the company. So what will be the method of the internal reconstruction? The first method is the alteration of the share capital. The second method is the reduction of the capital. The third method is the reorganization of the liabilities. The fourth method is the what? The writing of the fictitious assets as well as the losses. So first we are going to discuss, right, method of the internal reconstruction from the perspective of the alteration of the share capital. So it is what increasing, it is can be done by increasing or reducing share capital. Alteration of the, it means clear that we're going to alter, going to change the face value, the nominal value of the share. Means if it can be done by way of increasing, by way of decreasing, share capital, right? For example, 10 rupees share going to reduce to the 5 rupees. It means that by 5 rupees it is going to reduce, right? So it is the example of the alteration of the share capital of internal reconstruction. Second point was reduction of the capitals. The reduction in the paid up capital or face value. For instance, 10,000 shares of 110 rupees each reduced to 6 paid up. Means earlier on 10,000 shares the shareholder have to pay 10 rupees, means the nominal value of the share was 10 rupees, but now it has been reduced, as its name suggests, as its name clear, reduction of the capital means no more 10 rupees, but only and only 6 paid up. 4 rupees have forgone. So these 6 rupees will be paid up capitals, means internal reconstruction. It is the second method of the internal reduction by way of reduction of the capital. It have a both pro and con. It have a what impact on the balance sheet. So the third method is what reorganization of the liabilities. Creditors or debentures holder agree to accept lesser amount or convert into shares. And the fourth last method is what writing of fictitious assets as well as the liability as well as the losses. So accumulated losses, goodwill, etc. will be will be written off from the capital reduction. So these all are the various methods of the internal reconstructions. So uh, by way of illustration, by way of numerical information, we can study the concept of internal reconstruction. For instance, here ABC Limited has share capital of 10 lakh rupees, means 10 rupees each. Accumulated loss was given 4 lakh. Goodwill was given 1 lakh. While machinery was overvalued by 1 lakh, company resolved to reduce capital to 6 rupees per. So at the time of the passing journal increase, so we are going to fast necessary journal increase, like for the given information. So first will be here share capitals account of the face value means 10, right? It will be going to give it 10 lakh. Two share capital account which was has been reduced from 10 to 6. So we are going to record in the books of accounts mean journal increase two share capital account, right, of face value of rupees 6, which is amounted to rupees 6 lakh. 2. What about the reduction in the capital? It is one kind of loss. So 2 capital reduction account 4 lakh. So capital reduction account 6 lakh. To profit and loss accumulated losses 4 lakh. To goodwill account 1 lakh, it was already mentioned. To machinery account it was already mentioned 1 lakh. So this is the what the general increase was the internal reconstruction of the means based on the information given, right? So based on the information increase, general increase has been prepared for the same. So just right now we have discussed the concept of internal reconstruction, right? So now the next phenomena is what external reconstructions. So first try to understand its meaning. Means what does it mean of external reconstruction? Means the liquidation of an existing company and formation of a new company to take over of its business. In case of an internal reconstruction, no new company came into existence. But in case of an external reconstruction, one new company came into existence, means the liquidation of an existing company. So what are the difference between how it differ from the internal reconstruction? Means how external reconstruction is differ with the external reconstruction. So the first basis is the based on the legal entity, means legal aspects. So in case of an internal reconstruction, the same company will continue its operations, means its business, while in case of external reconstruction, the new company will be formed while the existing company going to liquidate. It is too similar with the amalgamation, with the acquisition, with the merger, but have differences. Second difference, on the basis of the liquidation between internal reconstruction and the external reconstruction. In case of an internal reconstruction, no company is going to liquidate it. While in case of the external reconstruction, the old company going to liquidate. So what about the from the accountancy point of view, internal reconstruction adjustment within the books. In case of internal reconstructions, mean internally, books of accounts, all the statement of affairs will going to revise. While in case of internal reconstruction, new books will be prepared. So these are the various differences between these two, internal reconstruction as well as external reconstruction. So moving ahead in the same phenomena, in the same line. So from the accountancy perspective, right, just try to understand the concept of internal reconstruction in the books of accounts. So examples here, an O company has some assets and the liabilities. For example, assets having 5 lakh, liabilities having 2 lakh, losses of 1 lakh. A new company limited is formed to take over the assets, to take over the business for 3 lakh 50,000. So in the books of old company limited, accounting will be made, means necessary books of account will be prepared in the books of X limited, in the books of old limited, as well as in the books of new company limited. So first we will discussing that what will be the accounting treatment in the books of old company limited. So realization account means all the assets and the liabilities going to record. Realization account will be debited to liabilities 2 lakh, to new company 3 lakh. So to realization amount will be loss of 1 lakh 50,000. So moving in these directions, there are loss of 1 lakh 50,000. Why? Because assets have been realized at 5 lakh rupees while the liabilities having 2 lakh rupees, and the new company ready to take over the business at 3 lakh 50,000. So surely there will be loss of 1 lakh rupees, 1 lakh 50,000. Meanwhile, other books of account will be prepared in the books of new company limited. Asset will be at 5 lakh, two liabilities, two liabilities account 2 lakh, to purchase condition 3 lakh 50,000. So this is the what the accounting treatment for the external reconstruction in both two companies. So now we are going to have a quick recap what we have discussed till now, that the concept of amalgamation we had discussed, the concept of external reconstruction we had discussed also the concept of internal reconstruction. So these are the different various concept, various phenomena, which is what having very similar with each other. So amalgamation, in case of amalgamation, two or more company merge, come into existence, right? While in case of internal reconstruction, say the same company will be going to reorganize. While in case of external reconstruction, old company replaced by the new company. So in case of amalgamation, two or more company combined. While in case of a external reconstruction, old company going to replace by the new company. So when we difference between among the concept like amalgamation, internal reconstruction, external reconstruction from the perspective of the identity. So amalgamation, new or existing, while in case of internal, the same entity will be here, while in case of external reconstruction, the new company came into existence. So pooling method, purchase method for the amalgamation, capital reduction purchase method, and the realization account will be prepared, capital reduction account will be prepared, and realization account will be prepared for the external reconstruction. So after a lot of discussion on the mentioned topic like amalgamations and external reconstruction and internal reconstruction, so this all about the lectures on the set topic we had discussed, you know the same phenomena, amalgamation, reconstruction, internal reconstruction, external reconstruction, from theoretical, from practical, right, point of view. So anyone, any viewers, any audience, anyone those who are watching this video having any kinds of conflict, confusion, or anything else which is not yet clear to you, so you may please contact us in our given in the given numbers. Right, I am ready to answer all kinds of queries, all kinds of confusion. Right, if you have any kinds of issue, doubt, confusion, something else which is not clear to you, you are most welcome at any times on the given number. You can contact us. Thank you. If you have any query, doubt, please write to us. We will be answered, right, formally as well as informally. So if you are having most welcome to address all kinds of questions, all kinds of conflict, all kinds of arguments. So this is the next slide. Thank you so much for providing me these opportunities to deliver the lecture on the said topic. So I also express to my sincere gratitude to the Dear University for providing a chance to make a video on these, as well as thanks, sincere thanks, right? Sincere gratitude goes to Center for Distance Learning for such a wonderful topic for the videos making. So thank you so much for you for watching this video, for your kind consideration. Thank you so much for have a patience. So wish you all the best. Thank you once again.